Hello everyone, warm welcome to the webinar on investments in the time of COVID-19. My name is Anuj Tambe and we have a special guest today, Mr. Nirav Karkera, Head of Research and Portfolios at MyWay Wealth. Over years of experience as a credit analyst, portfolio manager, and then as an investment research specialist, Nirav draws on a combination of economic insights and a deeper understanding of behavioral investing along with conventional wisdom to drive portfolio success. So welcome, Nirav.
Thanks, Anuj. Great. Feels great to be here.
Yeah. So, Nirav, this pandemic seems to have not only taken a toll on public health, but also on public wealth. Every day I receive a news feed about how stock markets have crashed and the lockdown. This lockdown is leading to a major economic losses in India. We are all hearing about this imminent recession, pay cuts, job losses. While we have faith that we will soon find a cure to this pandemic, where do you think that Indian economy will stand by this time? This time is over.
Very, very interesting question. In fact, we ourselves have been receiving many queries on similar lines. I've been personally, being asked by friends that abhi health ka chinta to kar hi rahe, but saath mein, our wealth is also eroding. Where do you think all of this is going to end up? So I feel this is something on the top of everyone's mind, and I'd like to share a couple of slides that I just have handy. It's not a presentation, but a few cards that I feel will help me explain the situation better. Yeah. So what I'm
Sure,
going to
Nirav.
do, yeah. Okay. So obviously, there's this pandemic, the lockdown, and ever rising uncertainties. Okay. So uncertainties across various facets. So now let's acknowledge it. Okay, it does sound like a thriller, action film, etc. But this time it is not fiction. It is happening in reality. Times like now are actually surreal. I stay in Mumbai. Mumbai is the city that never sleeps. But today, it has been over 45 days. That city has come to a grinding halt for all practical purposes. So, but at the same time, let's acknowledge a few parameters and a few things that are happening today. Okay, so today is a much better day. Medical science and technology today is at the most progressive levels. We are, at a level, at the highest level, at the most progressive level right now than we ever were collectively as, mankind, as a world in entirety. Global collaboration is at peak with a unified goal and a common enemy. For once, countries are not fighting each other but working together to fight a common enemy, which is not another country but a virus. So I feel this entire stance of a unified world strengthens our entire stance and fight against this pandemic. Countries are not holding back. Okay, every day I'm also reading about countries helping each other with be it pharmaceutical requirements to food requirements to monetary requirements. India hasn't been behind, and neither has any other country. Okay, so all of us are in it together. There is a strong feeling of being in this together. That is one great thing that has happened. That is happening today. Global banks are supporting the economies like never before. Okay, 2008 and 9 was perhaps the first episode where we saw the power of global banks unravel. And this time, global banks have been much more proactive, much more collaborative in their approach, much more coordinated in their approach. So the economies are being secured by global banks across the world and in a much more well synced manner. Okay. So best practices, learnings, moral support, free flowing across the globe through internet. There, we realize that communication and quick communication is such an asset during times like now, that all medical know-how, etc., is being communicated almost at the, almost instantly. So this is really helping a knowledge sharing and a knowledge exchange kind of a environment and ecosystem within the world, which is very important in taking our battle against the pandemic various steps ahead than what it is right now. So obviously this is about where we stand today. Now the question is about the economy, right? So I'm no medical expert in this conversation. I'll be steering away from making any medical comments, but at the same time I'd like to share a couple of opinions on where the economy is headed. Obviously economies will be shaken up. The real question is how bad. Okay, the economy will recover from coronavirus, but it will take patience. Goldman says downturn will be 4 times worse. The keyword here is we will then enter an unprecedented recovery zone. So the idea is that such a deep, crash in markets and in economies has been unprecedented for almost over a decade now. Okay, and given the fact that this is a pandemic-driven economic crisis, people don't are unable to actually gauge the severity of it. It is not due to a fractured economic system, but a health crisis in general. So I feel that markets tend to our economies tend to over reflect any situation when they are unable to gauge the actual intensity of it, and that is what is happening right now. Let's say once a cure or an let's say once we arrive at a cure or a vaccine, things are expected to take an unprecedented U-turn, and the recovery is going to be like one never seen before. Obviously, this is about the global economies, but we are worried about India, right? So one good news is, there is a common consensus that the world economy will go into a recession, but emerging markets, especially India and China, are expected to be severely resilient to this recession, to this impending recession. Um, in fact, the recovery is also expected to be faster than most developed nations. Okay, so 2020, we are going to be resilient. 2021 onwards, we are going to have a much faster recovery than most other nations. And this is due to a couple of reasons. Okay, right from our fundamentals being in place to our demography, being quite robust, etc. I feel India is very well positioned for a robust economic recovery. So let's take a look at what are the typical scenarios that can evolve. Okay, I don't want to leave you guys with a umbrella sort of a comment that India will recover fast. Let's just get into the painful situation. Okay, I want to address it. It might sound painful, but let's just talk about it. So the typical situation that may arise is one, it could be a tough economic crisis wherein we are somewhat on the verge of a recession. The only way to recovery is pent up demand, revenge spending, etc. And we'll bounce back just like that. Okay, it's just a matter of time when we bounce back. The second situation is a very tough situation wherein we are in an actual recession where businesses are consolidating, folding up shops, etc. There is massive job loss happening. By the way, today in India we are hearing a couple of news about pay cuts, etc. But trust me, this isn't as bad as a actually very tough recession, real recession, wherein there is mass job loss happening. We aren't quite there yet in India, and hopefully we don't get there. So here, the only thing that could really help is a cart full of stimulus, economic stimulus. Although stimulus is reserved for such real recessionary phases, India has been proactive and has already been doing it. We might enter an inflationary zone. We are not yet there. Okay, so the stimulus is not directly translating into a higher than expected inflation. So that's one good thing. And obviously, the final thing is like, oh, that's tough, right? So it is beyond just recession, almost recession, depression kind of a zone that we enter into. Then we're talking about large-scale bailouts, like perhaps reminiscent of what happened in 2008 and 9. We are talking about hyperinflation. We are talking about money just being printed, handed over, doled out to everyone, and the demand-supply economics going all over the place. So these are the three types of large bucketing that we can do of what economic situation can we enter into post-pandemic. Now let's understand the impact. So in the tough phase, obviously for a recovery, soon bonds will stabilize, equities will take you. Thoda bahut inflation and gradual recovery across sectors. It will be a broad-based recovery. A short-lived one, perhaps like the effects of the European debt crisis that we, the repercussions that we faced in India. Obviously not of the same nature, but the magnitude of a similar nature. In the next case, it could be perhaps the dot-com bubble type, situation wherein the recovery is slightly deferred. Major selective sectors to benefit first. So the sectors in which there will be major public expenditure, etc., they will be expected to benefit first. So public expenditure is going to be key to this recovery. And the third is a stretch period of economic lull. That is the toughest phase. Okay, I'm talking global financial crisis 2008 2009, the subprime crisis, that's what I'm referring to. So cash will be king. It's going to be a tough time for investors. It's all about who can hold through. It is at this juncture, it is more about how longer can you hold than what do you hold. That's going to be of more relevance. So these are the three situations that can pan out. Right now, we are on the verge of the first stage, that is tough. In varying degrees, it could get very tough. It could get extremely tough. But although I've tried to draw parallels with different types of historical crises, let's see what happened whenever there was a financial crisis. Okay, we spoke about the dot-com bubble, the global financial crisis, etc. As you can see, each time there was a crash in the market during the dot-com bubble, the market sell-off, global financial crisis, etc., so on and so forth. Markets have already, have always rebounded massively. Okay, and the greens that you're seeing is actually a 3-year CAGR. Okay, so if you want to gauge the real impact, a rough way to do it is multiplied by 3. So over the next 3 years in the dot-com bubble, which created a 65% correction, over a period of 3 years, it generated an absolute almost 100% returns. Okay, so this happened even in the past. Okay, so these three situations that I spoke about, it happened even in the past, and this is how it fared. Today we are in the final leg of this graph, wherein the COVID-19 pandemic had created quite a stir and a correction in markets. Obviously, it is no longer at a minus 38%. There has been a significant recovery, but this is the deepest crash. Okay, and we have already seen green shoots of recovery as and when we move ahead in time and we get clarity on the economic situation. So every financial crisis-induced stock market crash was followed by a strong recovery. This is one thing that I want everyone to understand. It has happened, and it will continue to happen that way. But for those skeptics who say that, oh no, but this is not just a financial crisis. Okay, this is because of a health crisis. This is because of a pandemic. Here's something I want you to take a closer look at. All of these financial crisis were triggered by a health crisis, by a pandemic of some sort, right from SARS to avian flu to Ebola to Zika and now COVID-19. The world only in the past 2 decades have gone through a number of epidemics and pandemics, and each time markets have obviously suffered a loss, but every time it only rebounded and bounced back much stronger. Okay, so for those of you who are thinking this is not just a financial crisis but a health crisis that has snowballed into a financial crisis, this is how things have panned out even in the past. Okay, and obviously most of us know that the mortality rate so far are not looking as difficult as it was looking in the times of SARS and HIV/AIDS, etc. COVID-19, we are rapidly moving towards a cure and vaccine. Just yesterday, I was reading a report about many manufacturers being in advanced stages of testing human clinical trials. There are a couple of drugs that have gotten emergency use US FDA approvals. In fact, Japan has already started the approval of allowing administering of remdesivir as a standard drug against COVID. Obviously, it is only, again, I would steer away from making a medical comment, but I can definitely see very proactive measures being taken in the right direction in this situation. So, when people say that this is a health crisis that has led to a financial crisis, I feel the financial recovery is also just around the block once we arrive at health recovery. So every time pandemic struck markets, it was followed by a long recovery. A small insight into lockdown economics. Lockdown 1.0, Nifty actually moved up, okay, during the period of lockdown. That a major reason being the intervention of RBI, India's central bank. A huge stimulus package of almost 1.7 lakh crore was announced. Rates were cut. Liquidity was flushed into the economy, and something as simple as moratoriums, like giving a deferment to people, letting people not pay their credit card and home loan EMIs and other EMIs for a period of 3 months. That is the root level to which RBI made a decision, and all of that had been stimulating enough for the markets to actually move up by an absolute 8.1% during lockdown 1.0. Next came the next phase of lockdown 2.0. During this phase, the markets went up by almost 10.5%. Okay, and during lockdown 2.0, again, this was also complemented by a series of measures by the government and RBI. Again, lowered rates, a lot of liquidity into the markets, specific sort of liquidity being arranged for mutual funds as well. So this is quite unprecedented. RBI never generally steps into capital market operations, but this time as an exception, it allowed for a 50,000 crore liquidity facility that mutual funds can dip into. So I'm seeing that the central bank is not really holding back. They are having almost all the cards on the table. And speaking about lockdown 1.0, 2.0, I think this third extension of lockdown 3.0 will also come along with a good series of announcements, and I can already see a similar trend of market recovery taking place even during this lockdown phase. Okay, so that is actually happening. As a final holistic view of where the world economy is going to be and where the Indian economy is going to be, let me tell you, if you take a high level view at this map, everything in red means negative growth. The deeper red means deeper negative growth, that is degrowth. Anything that you see in blue, bluish green, the more it gravitates from bluish green to white, it is going to be a growth in the positive territory. As you can see, India is among the very few nations that is going to post a positive growth. Post the COVID era in 2020, India stands to, the forecast stands at 1.9%, which is still positive. You can see every other economy being in negative. In fact, while India is expected to be among the very few economies to exit the pandemic with growth, we are also being pretty confident about the fact that India and China, and especially India more than China, is going to experience the highest degree of expansion in 2021. So this is not just something that I believe in or our team believes in. It is something that global analysts could also vouch for. So I feel, us being in India and being a part of the Indian economy is actually a great thing and a step. And we are pretty well placed to emerge as a very strong economy post this COVID era. So Anuj, that's how we are placed in terms of economics, and I feel people should sort of be confident of the impending recovery and be glad that they're part of the great Indian recovery story, which is going to be perhaps an unprecedented recovery in the history of global economics.
Right. Very insightful, Nirav. So, Nirav, we had planned a separate question and answer session, but our audience has already started asking questions. A lot of questions I see. And first question is, audience is asking whether we are doing question and answer session. Yes, we are open to questions. So you can start putting your questions in the comment section. I will just raise two questions which are very relevant to the topics which we covered till now. One is asked by Mr. Sushil Bhatt, which is the most likely scenario out of the three scenarios which we discussed, which is the most likely to be happened.
See, so the idea is, right now at this juncture, it is anybody's guess because we are obviously gaining clarity on the health aspect, but there is no short vaccine or cure that has come up. So a lot of it is dependent on how long will it take before we arrive at a solution for the health crisis. However, considering elementary points, I feel we should be somewhere between the first and second stage. We'll be almost on the verge of a slowing growth, not exactly a deep recession in India. Obviously, developed economies have already gotten into that, but I feel our fundamentals and economics are quite well in place to not plunge us that deep into a recession. But yes, there will be a slowing down of businesses, and it will be a tough spot. We may not. I'm pretty hopeful and confident that we won't reach the stage 3, but somewhere between phase 1 and 2 is where I would see India getting to, considering that we accelerate well on the cure and recovery of the health crisis.
Okay. So, Mr. Rishan Pearl is asking whether has market made its bottom already? What is your opinion?
Uh, okay. So, again, I hate giving this response, but again, anybody's guess. Okay. So the idea is we are very close to the bottom. Okay. That is one thing for sure. The valuations and the pricings are pointing towards that direction. Um I feel a better way to look at it is whether we are at reasonably fair valuation zones or not. Rather than checking if it is the bottom. I feel yes. We have entered very fair valuation zones. I won't say that it is the cheapest that the markets can get, but yeah, we are definitely at very cheaper price points than before. I feel now's if you're asking from an investment perspective, I feel now's a great time to load up on high quality stocks because they are available at quite a bargain price and valuation terms.
Right, Nirav. So, Mr. Rakesh Bhatt is asking what kind of fiscal stimulus is expected and what method is market expecting? What method of fiscal stimulus is expected by market?
Yeah, so we are expecting some more operations on the bond side of the market. Okay, so equities and bonds are not reflecting the same tone right now, the same tonality. It is very important. Both of them are on the same page. So the bond market has gone slightly dicey, jittery. We can expect a couple of novel interventions on the fixed income market side. With a two pronged approach. One, to bring in a lot of stability on the debt side, and also to bring in a lot of liquidity into the market. And there will also be a lot of focus on transmission of any policy action. So more than just action, there will be a focus on ensuring transmission of all actions and ensuring that the benefits trickle down to the root level.
Okay. So now this question is in my mind. Now we are seeing job losses a possibility, although government is requesting not to move to this hard step. But we are seeing job losses. So for those who may be able to like foresee such event, fortunate event, what do you recommend? As in, what tip you suggest to brace for the winter?
Right. So obviously, times like now, it is pretty valid to have concerns about job loss, etc. At this juncture. Given the uncertainties, but there's no point, putting our head into the ground. We need to address this sensitive topic. None of us really think that can happen, but actually we should. So I am having a single slide that can actually help us understand, or let me share my thoughts better. I'm just going to share it with you guys. Let's see if it helps any of you. Yeah. So obviously, losing a job is a dreadful thought, okay? But there is only one thing worse than losing a job. It is presuming that you could have never lost your job. So here are a few, preparation pointers that I feel would help everyone. And let me tell you, it is not going to be run of the mill that save a lot of money kind of a situation. But you'll be glad that you followed these pointers, even if you don't lose your job. I'm really hopeful that no one here loses their job. But if you stick to these principles, I feel you'll be in a better stead and in a better financially secure zone altogether. So, like I said, it's not just about creating an emergency fund. So, one, you should review your medical insurance. Okay, that is point number one. Your employer provided cover does not count because, hey, if you're going to lose your job, your benefits also go out of the window, right? So, you no longer have a medical insurance offered by your employer as well. You're out of that group. So review your medical insurance. See, times like now, as it is, the financial conditions are getting tough and tougher, and the job loss could be quite harrowing. And at the same time, I believe that medical expenses are quite unpredictable, unforeseen, and they come in as a financial shocker. Okay, so the bills are quite huge. No matter how prepared you are, it always tends to be expensive. So please review your medical insurance. Try to have an adequate cover. Okay, your cover should, you should try to have at least a 5 lakh cover basic. It is all about your affordability, but at least this much as a rule of thumb, or whatever you can afford right now. Obviously, times like now are a reminder to why term insurance is important. This is a pure life cover, no frills. This is a situation where if anything unfortunate happens to you, uh, this kind of becomes a substitute to your income for your family. Obviously, there is no substitute to the emotional loss and pain, but a financial loss and pain. Right in the middle of a huge emotional setback only worsens the situation. Even that's a fact of life. So any sort of comfort for people who are dependent in terms of having a proceeds from a term insurance would be very helpful. So please review that situation. Obviously, all of us have been dreaming about this state where we can have some spare cash. Okay, all of us love to have some spare cash in the bank account, but we haven't been able to do that for a long time. Quite often on month ends, we most of us make this promise to ourselves कि अगले महीने कुछ तो पैसा बचाएंगे, but that doesn't quite happen. So now you really need to make this dream come true. Okay, this is no longer a hope, this is a necessity. Try and set aside spare cash. Times like now, when only essentials are available, you will be saving on a lot of cash. Do not squander unnecessarily. Every rupee is important. Okay, cut back. So movies, obviously, since the theaters etc are not open, you got to sit at home, but make it a lifestyle for some time, at least till you're out of the economic pressure phase. Stick to Netflix or Suryavansham, whatever you enjoy. Dinner, always choose a comfortable home cooked meal. Trust me, it is much healthier and much more economic. There's no loss in having a home cooked meal whatsoever. Loan EMIs, credit card dues, etc. You might want to consider the RBI moratorium. Please understand, it is not a waiver, it is a deferment. You can continue making your payments after 3 months. If you take the moratorium, means the payment you have not made for the 3 months will stretch over the rest of your loan EMI period, or else will be added as a lump sum to your next EMI. One of the two needs to happen. The interest will continue to accumulate. So there is a cost attached. The interest cost is attached. It is not a waiver, but let's say you're really in need of this liquidity. Do not shy away from availing it. It will only help you tide over the situation in a better way. So yeah, so these are a few pointers that I believe will help prep you for the job loss situation. Obviously, I'm very hopeful it doesn't happen to any of our viewers here. But if it happens or doesn't happen, these are some basic financial prudences that you must follow to have an overall financial security. Yeah.
So now many questions are coming from our investors who are actually invested in markets in these times. So there are questions like they are seeing their portfolio in red. So what do you think is the best way ahead for investors? Is it a good time to redeem or invest more?
Very interesting. Very interesting. So I, it is I knew that such a question would come up. Okay, so I had a couple of slides on that. So this is something that is quite often asked. So trust me, guys, you're not going wrong if you have this query. Almost everyone has this query at this point in time. Okay, so I'm just going to move ahead. So you need to understand, okay, a lot has happened yesterday, a lot more is happening today, even more will happen tomorrow, okay. You'll see markets swinging in different directions. You need not react always, okay. Not acting upon something is perhaps the highest form of action. It is okay to not react. You need to understand that, it has been years and we have observed that there is a huge gap between investment return and investor return. And this gap has a lot to do with the behavior of investors. Okay, so this is obviously taken from a favorite book, The Behaviour Gap by Carl Richards. So this is very well illustrated of what really impacts your returns. I feel at times like now, behaving and reacting, or in a way not in the right way, makes all the difference. For those wondering if they should redeem, cut their losses, and withdraw, you got to understand this, okay? So if you keep buying at a higher price point and keep selling out of fear at a lower price point, you will end up broke. Okay, that is a fact. Do you know what the number one rule to make profits is? It is to buy low and sell high. And if you have done something opposite, there is no way you can ever, make profits on your investments. So please do not do anything so counterintuitive out of fear. Do not, buy out of greed at a high point only to sell out of fear, because you will continuously repeat this till broke. Again, an illustration by by uh, by Carl Richards, a prolific writer. I feel at points in time like now, the time you spend in the markets will be very critical in, determining how do you fare. This is a historical study of, across since the inception period. Okay, since the Bombay Stock Exchange was launched, since BSE Sensex was launched, the more you hold, the higher is your probability of exiting with a profit. So historically, as you move from 1 day to 1 week to 1 year to 3 year, your probability of exiting with a profit out of Sensex goes up to almost 80%. And as you move ahead in time, your probability of profitability only increases. So your time in the market is essentially more important than timing the market at this juncture. Most of you obviously have this question ki markets have crashed to very low levels. What if it crashes even more? Let me give you a simple illustration of, I am sure most of you know this, but I still want to rub it in. Okay. When markets are at 100 and you invest 100 and the markets then fall to 50, you lose 50% of your money. But let's say when you invest during the crash, okay, when the markets are low at a 50 and you invest a 50 and the market simply recovers only to where it was earlier, okay, it just recovers from 50 to 100, you have in fact gained 100%. So a drop from 100 to 50 is a minus 50%, but an increment from a 50 back to 100 is a return of 100%. And it is all about accumulating during such lows. This is what happened right now, okay, during this situation. Markets tanked by almost 38% in the COVID pandemic. 23rd March was the lowest point in the markets. It went down by 38%. Yesterday, day before yesterday, 6th May, markets from the lowest point already recovered 30%. So people who invested at the peak and booked losses of a 38% actually converted their notional losses into real losses. And the guys who started investing at the bottom by continuing having faith in the markets actually booked an absolute 30% profit within a span of almost hardly 10 to 12 days, trading days. I'm not advocating trading or quick money, but this is how the markets work. Had you not sold off during the dip and had you only bought more of it, your cost would have been average. Your average cost would have gone lower, and you get closer to entering the green zone or the profitability zone faster than you would have by simply staying put or by simply staying out of the markets. Okay, I'm not asking you to take punts. Do not construe this as advocating trading. But I feel if it is in line with your asset allocation and your investing discipline, now is not a time to make any changes there. Okay, so you miss 100% of the shots you don't take is something that Wayne Gretzky said. He's a great hockey player. So I feel this puts a lot into perspective. Okay, I feel times like now has a lot to do with the way you behave. This is a graph by the visual capitalist. As you can see, initially, this is how the emotional cycle goes along with, markets. When things are low, there's disbelief, there's uncertainty. As things start going really well, we are kind of optimistic, enthusiastic, euphoric about markets. थोड़ा सा dip आ जाता है, we start moving into the anxiety, denial and panic mode. And this only snowballs into further capitulation. Okay. And at a very low point, then starts the herd mentality of let us all exit the stock markets. No one can ever make money in the stock markets. The pain increases, it enters an agony zone. And then there is a depression zone wherein the clutter is cleared, the traders, the speculators, etc., are out of the market. There are only real long-term investors. There are rational investors who see the real opportunity, and that's where the recovery starts beginning from. This has happened during multiple cycles, even in the past, and we are seeing it happening even right now. And I'm expecting the same trend to even continue further. This is the spot where we are right now. Okay, we are somewhere around the capitulation and agony zone. I believe the rational investors who understand that this is a phase and an economic and an emotional cycle, and they stay put during these phases, are the ones who will benefit the most. So that's my idea on how should investors be. A key takeaway, just in a summary format, is the ability to time the market right does not require just knowledge. It requires some amount of psychic ability. You should be able to forecast and predict what are millions of minds and billions of dollars going to demand or sell. So you might as well drop the idea. The idea is to be disciplined, to buy good quality at all prices, stick to financial discipline, stick to long-term investing, steer away from trading, market timing, etc. SIPs, STPs, mutual funds are your best bet. Stick to investing with people who gain when you gain, who lose when you lose. Mutual funds, as a concept, fund managers and mutual funds earn only if they ensure that you earn. Because the lower you earn or the more losses that you incur, even they sort of earn lesser in those periods, because their earnings are basis your earnings. So that's a real great way to ensure you have the experts of the industry have skin in your game. Don't trigger panic selling. Don't convert your notional loss into real loss. One thing, I always tell people, close your eyes and swear to yourself, you always knew that equity markets are going to be volatile. Okay, not for a moment did you ever expect it to be linear. It is just that when it is coming to your face and right in front of you, you're getting jittery. I'm not saying it's wrong. It is quite natural. But understand that you always knew it. You always knew that market cycles are called cycles for a reason. Stand your ground right now. Now are testing times. Brighter days are ahead. I feel we are already into the dark zone. Now is in fact a great time to accumulate well. We are close to the bottom. We are cheaper, not the cheapest, but we are quite cheap relatively. Do not change your risk appetite or your financial plans or your discipline or your asset allocation because of the markets. Your investing plan is always created considering a volatility. Okay, so stick to your asset allocation, stick to your investing discipline. I feel that should really augur well for investors seeking to make great returns at this juncture.
Okay. So, Nirav, on the investments, again, some specific questions are coming now. What is, since you brought topic of asset allocation, what should be a asset allocation? How, whether investors need to reorient themselves, realign their portfolios? So, Mr. Sayan Banerjee is asking, Nirav, yeah, can you hear me now?
Yeah, could you please repeat? Yeah,
so on the asset allocation part, whether investors try to rebalance their portfolios considering this situation, Mr. Sayan Banerjee is asking, what is the which is the most secure way of which is the most secure instrument, asset class, basically, in this current time?
Okay. So the idea is a rebalancing should be conducted only in line with your asset allocation. Okay. You definitely need the help of a financial advisor or an expert in this regards. Do not try to take this decision on your own unless you're from the same domain and understand it well enough. You can rebalance your portfolio. Now is a good time to look at it. You may want to ensure realignment with your asset allocation and your financial plans. Now is a good time to review your allocations. However, this is not very pertinent to only this time. This should be standard practice. Eventually, from time to time, like on a quarterly or a 6-month basis, you should be reviewing your portfolio as a hygiene. Apart from that, when we talk about instruments having lesser risk, obviously equities is not there over here. We can definitely look at mutual fund instruments like overnight funds and liquid funds. I'm expecting that you are not looking by less risk. You're talking about very less volatility. You just want to park your money. You don't want to take on much volatility. So liquid funds, overnight funds, for very short duration holdings like up to 3 month kind of holdings, these can augur really well. For ones who want to just park their money for 3 months to a year kind of a thing, but not exposed to high degrees of volatility and have tax efficiency, you can explore arbitrage funds. So they are expected to give good returns with very less volatility if you're and very high degree of tax efficiency if you're seeking to invest between the 3 to 12-month period.
Okay, so Nirav, since you brought topic of debt funds, debt as a category,
Yeah.
I'm picking one question from audience. Mr. Avinash Sorte is asking, is there any susceptibility to the credit risk category, as all MFs or AMCs are aligned to have some portion to portfolio loaded with high return credit investments? So where do you see this category after Franklin Templeton episode?
Yeah, so the Franklin episode was, came in not as quite a surprise. Okay, in fact, for the investors and the viewers, I'd like to say that one must not look at the Franklin episode negatively. One must receive it as an act of good faith, an act of responsibility, and an act of being proactive from an AMC standpoint. They could have continued the fund. But the idea is to protect investor interest. It was definitely a tough call for the AMC as well, I can understand. But also it was in best interest to not, further deepen the losses and, cut it as soon as we recognize the risks emanating. So that is one thing. So sure, there is a lot of increased risk in the credit risk segment. In fact, anything below AAA rating, we are seeing a spike in the yields, and we are seeing liquidation happening at erratic spreads. Most of which not really explainable by anything else other than panic. There is some amount of pressure that is only redemption pressure that is only snowballing the pressure on sub-rated credit risk instruments. We have maintained this view almost since almost since early 2019 for investors to steer clear from credit risk. This is so I feel the pandemic has only given it a nudge or a push in a particularly panic zone. But the problem was there since the ILNFS crisis. We never quite recovered from it, since the time it happened. So yes, so obviously the problem is much more pronounced now because of the pandemic, but this was there all along. For investors seeking to invest in debt, now is not a great time to take on credit risk, given the increased level of uncertainty. One must try and increase exposure to sovereign rated, AAA rated debt funds. You must stick to, unless you're quite confident or your advisor suggests so, you must not try and take any duration calls. You must also stick to only very low duration, ultra short, overnight liquid sort of debt funds. Also ensure that most of these funds have a high degree of exposure to sovereign and AAA rated instruments. And bottom line is, you do not take on any incremental amount of credit risk at this juncture. AMCs are also trying to trim their exposures, but as far as you can manage, avoid taking such exposures.
So one question coming from Vikas Bijlani. This is like very specific and subjective. I would say, when do you decide enter timing in the market, time to enter and time to exit?
Okay, so Vikas, at the outset, again, the phrase that I use quite often, but hate to anybody's guess, yeah, because if anyone in the world knew what was the right point to enter and what was the right point to exit, we'd have many more billionaires than we already have, right? And while it is very difficult to predict that, people like me, our job is to try have a educated guess on these ranges. Let me put it this way. if you're trying to decide to invest, it has more to do about your time in the market than timing the market. Like the slide I showed, the longer you hold, the closer and the increased probability of profitability is there. If you are typically asking whether now is a great time to invest, I'd say yes. Now is a great time to invest, and more on a, at the cost of sounding cliched, a great guy, I'm guessing it was Warren Buffett, he had said that the best time to invest, the best time to plant a seed was 20 years back, and the second best time is today. And the same goes with investing. The best time to invest was 20 years back, and the second best time is today. And in fact, I feel times like now, wherein we are seeing a steep correction, only strengthens the case for you to invest into the markets. And exit, I feel you should exit only when you are in need of the cash. Okay, so let's say if you have invested towards a financial goal, you must exit when you reach that financial goal, or when your investments has reached that target amount that you wanted it to reach. I feel these are two good trigger points to look out for in terms of getting the time right to exit. So I hope that gave you some sort of clarity around the timing of the market.
Okay. So Nirav, Mr. Rakesh Bhatt is asking on fiscal deficit. Where do you see fiscal deficit heading, and what will be its impact on markets?
So see, the idea is the fiscal deficit is heading towards a painful zone. Okay, I won't mince words. To accept the truth, it is entering a painful zone. But right now, there's a choice between survival and fiscal prudence. Okay, I feel that it is okay to take a gunshot if it means that you can live to fight another day. I feel we are in that sort of a situation right now. Our fiscal deficit situation is surely worsening, but you will also agree that the larger market also is of the similar view, and the opinion that it is okay because we will live to fight another day, and hence you will see markets not really reflecting quite a the market is not reflecting anything sad or unfortunate because of the deepening fiscal deficit. In fact, if nothing, there is some bits of enthusiasm that we are pouring in more, and we are not trying to be very prudent when the question is of survival. So market players are taking it positively. I feel I get where you're coming from. The truth is the fiscal deficit situation is worsening, but we will gradually recover. It is all about tiding over this phase and surviving through this phase. Once we are out of this post pandemic era, like I said, India's other fundamentals are quite well in place to help it recover economically, which does not include just its GDP situation but also its deficit situation. We are placed really well to improve on those fronts.
Okay. So one more question looks interesting to me in this time now. How do I reassess my tolerance to risk in equity market in this time?
Okay. So, and how do you reassess your risk
One
tolerance?
more, there is one more similar question. So I see a lot of aggressive investors in this time also asking what options are there available for them. For example, Mr. Siddharth Bijapurkar is asking what are the lucrative options for me. I am an aggressive investor.
Nice. So one thing, I'll address the first question and then move on to the next. The only reason why you should reassess your risk appetite is if there is a change in your financial or personal condition. Okay, your personal risk profile does not change in line with the markets; it changes in line with your personal situation. So if there is anything that has changed in your personal life, let's say increased dependency, increased loans, or a pay cut or a job loss or any of such thing has happened, now is a great time to reassess your personal risk appetite. So that is point number one. Point number two, so while it is unfair to make a blanket statement of which are great segments to invest into, because this is very particular to has a lot to do with your personal investment and investor profile. Okay, so how long will you invest, what's your personal risk tolerance, etc. But since the question has been asked, let me say I am viewing large caps, typically the heavyweight large caps, I'd say the heavy market cap companies to be in the first order of benefiting from an economic recovery. So I'm having a sort of a bias towards large caps being first in line. This does not necessarily reflect an adverse opinion on the mid and the smaller caps, but yes, definitely I'm seeing the large cap equities perform better, faster than the other market caps would perform in the time to come. Yeah.
Yeah. So a lot of people are asking questions on asset classes such as real estate. They want a comparison between real estate, gold, debt, equity. A lot of questions coming on gold. So would you like to answer your view on gold and
Yeah.
real estate?
Okay, so I'll take the painful bit first. Okay, real estate first. Real estate. The decision on real estate is slightly broad based, but let me try and sum it up for you. Real estate at this juncture is under a lot of stress as a sector. Most of you would expect a sort of a fire sale in the real estate segment, wherein you may get your hands on a couple of good blocks of real estate, but you must understand that it comes across with its own set of challenges. One, obviously you need to review your situation if you're willing to take on a loan for such a huge amount. Quite often than not, people don't buy real estate on cash. No one has so much cash lying around. Two, the holding period is just too long because the amount of unsold inventory in real estate is so huge that by the time the market gets saturated enough that your piece of real estate starts commanding a premium because of scarcity of supply, it's going to be quite some time. Okay, so there is a lot of unsold inventory already. Third,
Right.
highly illiquid investment. Okay, you cannot liquidate it in fractional pieces. You cannot sell off 1 square foot to meet certain demands, etc. And also, you cannot liquidate it almost immediately. So that is there. It has a lot of regulatory cost attached to it. Stamp duty, registration, etc. Under construction projects, all the more riskier at times like now when refinancing and getting any sort of finances not as easy as it used to be, with banks being very selective of how do they deploy their money. So all in all, real estate is a tough, investment class to enter into, and the trade-off of uh, cost versus benefit trade-off is not really as interesting as other asset classes. So I feel, in personal opinion, unless it is for consumption, you might want to steer away from real estate as an asset class. Let's talk about gold. Okay, I feel gold, like every crisis situation, has reflected, and every economic cycle has reflected. Gold tends to be a stable storage of value. Its value tends to increase as and when people shift away from riskier asset classes like equities. People don't want to take such sort of a risk. Even right now, we are seeing a flight of capital from capital market assets to gold in general. So gold is definitely a great asset class. It has a lot to do with how do you invest in gold. One must definitely, okay, to give you a point, very specific answer, you must definitely invest in gold. There should be some allocation in gold. Now moving ahead to what is the way in which you invest in gold. uh, you must steer away from buying gold jewelry as an investment, because it comes along with a lot of physical storage charges, purity issues, concerns, a lot of making charges, etc. That actually sucks out its upside potential in terms of giving you benefit that an investment into gold would. I feel one should move towards buying gold mutual funds, which is a much more simpler way to take exposure to gold ETFs. You need not have a demat account, etc. You can simply buy gold mutual funds which replicate the movement of gold ETFs. And two, you must try and buy digital gold. Digital gold is a really smart way to accumulate gold. You can accumulate it in the digital vault or digital locker. It does not come along with additional costs, impurity concerns, etc. It is all backed by trusted custodians and suppliers. In fact, most digital gold service providers or product providers also offer the option to claim a delivery, a physical delivery of a gold coin in terms of bullion, etc. So I feel for those of you who love having gold at home for some reason, digital gold is a great way to look at. And also digital gold and gold mutual funds are highly liquid in nature, unlike physical gold where you need to find the right buyer, go to stores, etc. In mutual funds and digital gold, you need not really worry about that. It can be liquidated almost instantly online. So I feel these are the smart ways to invest into gold. And yes, there is merit in diversifying your assets into gold.
Good insights, Nirav, on digital gold. So I would like to inform our users, we are not just a platform limited to mutual funds from investment point of view. We also offer a digital gold. So digital gold option, as you said, lucrative is that option of investment is always available on our platform. Users, investors can invest in fraction of minute or second. I would say it's a very seamless into this asset class. Okay, coming back to question, I will now not take name of people with a lot of questions, and I will try to club similar questions. So questions are three questions have come on specific sectors. For example, Sudhanshu Anand want to know how does outlook for health sector and thematic funds look in the long term, and again similar question on what industries and sectors will get benefited post recovery. What is your
Right. So the idea is that so when we talk about, so let me pick one sector at a time. There was a question around health, right? So when you speak about health, I am presuming that you're talking about pharmaceuticals, diagnostics, and healthcare as a segment. Okay, so we are pretty confident about these sectors to do well moving ahead. So in fact, times like now is a great time to load up on healthcare themes. I feel more than but this needs to be very specific. Okay, the investing cannot be based on the sector. It is very stock specific in nature. You need to know the right kind of stocks in diagnostics, the right kind of stocks in healthcare, the right kind of stocks in pharmaceuticals. So I feel you must stick to great, pharma mutual funds, pharma healthcare diagnostics oriented mutual funds, wherein the stock selection is very strong. As a theme, it is really great. You can start increasing exposure. There is no reason to go overboard on it. But there is no reason to steer clear from it. Ensure it has a decent 5 to 8% kind of an allocation into your entire portfolio. This sector tends to be highly cyclical, so accordingly steer between toggle between 5 to 8% scales to allocate towards the segment. Even you must understand that healthcare is also now in some way I would also include insurance as a subsector into the health segment itself. For some purposes. Okay, obviously I know it is financial services, but you might want to take a look at that segment as well. So that's about it. About the health segment. About the auto ancillary, it is expected to undergo some degree of pain for a shorter period in time, just like most other sectors are undergoing. But auto sales, like we all know, is among the primary leading indicators of an economic recovery. And if we are confident of India actually recovering economically, and if we were to believe in the global consensus that the expansion rate is going to be the highest in India in 2021, I don't see any reason to steer clear away from auto sectors. I feel both in healthcare and auto, it has a great deal to do with the holding period. These are not very tactical calls, not quick response calls. These need to form a part of your overall strategy and need to be held through a longer period, through the entire cycle that is there. Both of these are cyclical and needs to be held for a longer term, but I'm confident it will result in very good returns going ahead.
Nirav, I think we have covered most of it. We discussed current economic situation, how markets have reacted to such kind of situations in past. Then we discussed about asset allocation. We discussed
Yeah,
about debt as a category. We have covered many of questions coming from audience.
right.
We'll pick up one last question from audience. Mr. Rakesh Bhatt again asking on what about corporate perpetual bonds at 8.5 to 8.85% coupon rate, better than FD or equity MF in these times?
It's an interesting question. Yeah. At the very outset, let me tell you these three have very different profiles and are meant for very different risk appetites and very different portfolio allocations. Okay. So comparing a corporate bond to a fixed deposit and to equity wouldn't really be apple to apple. But since you asked about it again, I'd like to gravitate back to my earlier stance on debt mutual funds. That the situation is sort of tough in the corporate bond segment. You need to be really careful and selective about what corporate bond you are investing into. Even if you're an aggressive investor and you are willing to take that sort of a risk in terms of credit risk, I feel you need to be very critical about the allocation that you're giving to these corporate bonds. You need not go overboard on it. Only if you're feeling too adventurous, feel free to add an element of it. But this do not expect it to be safe in any way. Okay, so there's nothing called as safe investments. And especially at times like now. So if I were to put it in a scale, I would rate bank fixed deposits as uh, the safest at this juncture, relatively safest at as compared to corporate bonds and equities. And by safe, I mean there's no volatility here, and I don't expect. I'm not seeing any banks defaulting anytime soon. At the same time, corporate bonds may come with its own set of issuer-related risks. So be very careful while you dabble into it. And obviously, at the highest of the risk pyramid would be equities. Obviously, it is risky, but it is a very promising asset class, inflation-beating asset class. It needs to be in line with your risk profile, and you need to really understand the holding period required for you to go through the entire cycle and make some really good returns on equity, like almost many long-term equity investors have already made in the past. So that's how I would position corporate bonds, fixed deposits, and equities across the spectrum.
Okay. Nirav, I think this was a really comprehensive, informative session. I
Yeah,
really hope that our investors, all the participants, have found this webinar equally insightful and helpful for them. We really thank you for your time, Nirav.
sure.
Uh, yeah, so participants, please subscribe to our channel. And yeah, so this is time to say goodbye. Thanks, Nirav. Thanks, everyone.
Thanks, Anuj. Thanks, everyone. It was a pleasure interacting with all. Thanks, Anuj, for arranging this. Good luck.